an empire, a mountain of cash, $344 billion, idle money bleeds. Warren Buffett doesn't let cash sleep. He wants to swap $10 billion for a durable money machine. Its name, OxyChem, Occidental's chemicals arm. The question is simple: is this a cash cow or a cleverly disguised cycle trap? We'll peel it back, layer by layer, capital flow by capital flow, metric by metric. Welcome to Billionaire Investment, the channel that tracks capital. No rumor chasing. We follow where the money goes. Today, 3 parts: why Berkshire is spending, why Occidental is willing to sell, who really wins this chess match. At the end, a KPI map, short, clear, ready to use. The big picture. Berkshire is close to a deal, target OxyChem, price tag about $10 billion. If it closes, it's Berkshire's largest acquisition since 2022. Backdrop, a record cash pile. T-bills pay approximately 4%. Fine, but not enough for truly durable cash flow. Occidental is the mirror image. Capital-heavy oil and gas deals, thick leverage, high interest cost. They want a lighter balance sheet, a tighter model, back to core upstream E and P. So what is OxyChem? Not crude oil, not hostage to today's barrel price. Its industrial backbone, the chlor-alkali chain, chlorine and caustic soda, plus derivatives like VCM that make PVC. PVC goes into water pipes, building materials, medical gloves, factory staples, and especially clean water treatment. Broad baseline demand. Less about trends and fads, more about daily repetition, year after year. Numbers that signal resilience. Trailing 12 months through June, nearly $5 billion in revenue. First half alone, over $2.4 billion. Not a rocket, a turbofan. Quiet, steady, long-range thrust. That's what Berkshire wants. A reliable cash cadence that outpaces short-term yields without getting tossed by market crosswinds. Why does Berkshire want it? Put yourself in charge of $344 billion. Every 1% yield difference is $3.4 billion plus per year. Pull $10 billion out of 4% T-bills and you forfeit $400 million of safe annual interest. The new asset must clear that bar, more stable, more consistent through the cycle. That's OxyChem's exam. Berkshire understands chemicals. In 2011, it bought Lubrizol, a specialty chemicals business. OxyChem is more commodity exposed, so margins swing with supply and demand. The trade-off, scale and baseline demand. Clean water demand doesn't sleep. Building materials don't vanish. Healthcare can't pause. Repeat demand plus disciplined operations equals a cushion against volatility. And Occidental, why sell? Think of leverage as a weighted vest. Running is harder, jumping is slower. Selling OxyChem brings in a large check to pay down debt. At say 5 to 7% average interest, pre-tax savings could be $500 to $700 million a year. After tax, still meaningful. Capital moves from the engine room to the cockpit. The company breathes easier. The market story is cleaner. Pure oil and gas, lean, clear, easier to value. No money machine is immune. Risks. 1. The cycle. Chlor-alkali and PVC are industrial commodities. When construction slows or manufacturing softens, pricing compresses and margins tighten. The offset is baseline demand. You can't switch off clean water. Hospitals still need gloves. Paper mills still need caustic soda. Baseline demand is the natural safety net. 2. Sustaining capex. Membrane cell electrolysis cuts power use, lowers emissions, and lifts long-term margins, but it needs steady capital and serious upgrade schedules. Go too slow and efficiency erodes, too fast and cash drains. Balance is everything. 3. Approvals. Large deals face antitrust review and environmental checks. A hard block seems unlikely, but waiting time is a variable. Cash hates suspension. Investors hate information voids. Expectation management is mandatory. Impact. Berkshire benefits the patient way. Less cash drag, a higher share of durable cash flows. If OxyChem converts operating profit to strong free cash flow, 4% becomes the starting line. Add time, add discipline, add compounding, the cash pile starts flowing like a river. Occidental benefits immediately. Cash in, debt out, interest down, net income thicker, credit stronger. A cleaner, pure-play oil and gas story, easier for investors to read. Yes, exposure to oil prices rises, but in exchange for a healthier balance sheet. That's the economic trade. Follow the capital, sources and uses. Berkshire, cash and T-bills, carve out $10 billion, pay cash. No equity dilution, no structural complexity. Occidental proceeds in, used to retire high coupon or near-term maturities. Interest savings start next quarter. Earnings impact is real, fast and clear. The hurdle rate, non-negotiable. When you leave safe, continuous assets like T-bills, you need a hurdle. With $10 billion, 4%, approximately $400 million per year to beat. OxyChem must clear that consistently through up seasons, down seasons, and short-term shocks. How to clear it? 3 gears. 1. Operational efficiency. Plants run steady, volume steady, logistics optimized. 2. Customer diversification. Water treatment, healthcare, paper, construction. No single-leg dependence. 3. Capital discipline, capex where it counts, membrane upgrades on schedule, no reckless expansions, no chasing revenue at any cost, protect margins and cash. The practical part, track the deal with 4 KPI nails. KPI number 1, price and valuation multiple. What earnings base is used post carve-out? If the multiple is sensible and the profit base transparent, check. KPI number 2, Occidental's use of proceeds. Which tranches get paid? What coupons? How much net interest saved per year? Does the maturity ladder align with operating cash flow? If clear, check. KPI number 3, capex and technology roadmap. How much for membrane upgrades? Expected energy savings? Long-term margin lift? Basis points? Are milestones on track? If discipline holds, check. KPI number 4, regulatory timeline. When were filings made? How long is the review window? Any RFIS? Expected close date? If timing is transparent and extension risk is low, check. Sentiment. Markets like readable stories. Berkshire swaps sleeping cash for flowing cash. Occidental swaps heavy structure for a leaner one. Both paths make sense. One pursues durable cash flow, the other a clean balance sheet. When both win, investors can be rewarded via multiples. Local economies benefit from steady sustaining capital expenditures, plants keep jobs, supply chains hum. But don't romanticize it. Cycles are still cycles. If construction slumps, exports clog, or power prices spike, margins thin, and cash slows. That's when capital discipline gets tested, and Berkshire's philosophy kicks in. Patience, long holds, operational optimization over hurried churn. To wrap, 1. Berkshire has a mountain of cash and needs a durable cash machine. If run right, OxyChem fits. 2. Occidental wants the best off. $10 billion reduces debt and interest, clarifies the core story. 3. Risks exist, cycle, capex, approvals, but they're manageable with discipline. 4. KPIs are the compass. Pin down the 4 nails and you won't get lost. The lesson isn't the $10 billion, it's capital design. Money must have a job to make more money durably, steadily through cycles. Buffett's answer: turn a cash pile into a cash cow, from vault to money machine. If you agree, comment in caps, cash flow. Like, share, subscribe, and hit the bell for the next KPI update. See you on Billionaire Investment